That is the closing bell on Wall Street, and now it's market domination overtime. I'm giving you full coverage of all the moves to get you up to speed on the action from today's trade. And Yahoo Finance's Jared Blikre joins us now with the latest market action. Jared.
Thank you, Josh. We're looking at gains across the majors, plus the Russell 2000. Not big ones, but I think investors will take it after what was not the greatest start to the month yesterday, and call it turnaround Tuesday or whatever. We're looking at the Dow net up 184 points, or about 0.4%. NASDAQ up a little bit more than that. You can see kind of in the middle of its daily range there. S&P 500 also in the middle of its range, up a quarter of 1%. And then the Russell 2000 up a little bit less than that. So not a huge day in terms of volatility or action, at least on the surface level of the indices. But we do have some interesting nuggets to reveal under the market's hood. And let me go over to the sector action first. Tech was the leader an hour ago. It's still the leader at the end of the trading day, up 1%, followed by industrials and communication services. Those were the only sectors in the green and the only outperformers of the S&P 500 here. Energy still the worst off, down just a little over 1.25%. Materials, utilities, staples, healthcare, real estate, all of those also down on the bottom row. And let's take a look at the NASDAQ 100. I have to call out Apple here. It did in fact notch its seventh straight day in a row. Here's a 10-day look. You can see that chart up 7% coincidentally over that time period. 6 of these last wins have been record all-time closing highs, so quite an accomplishment for Apple, which really came back late in the cycle here. A lot of other stocks in its cohorts raced up after that April low, but Apple kind of pulling it out in the end here, at least the end of the year. And let's take a look at the Dow as well. To the right side, you're going to see quite a bit of red there, so not the greatest mix aside from the mega caps. Boeing is a huge standout. That stock, let's do that in an intraday. There we go. Up about 10% today. Honeywell up 1.5%. Caterpillar up 2.5%. So that accounts for those industrial wins that we were looking at in the sector action before. And then in terms of transportation, I got to call out the airlines because we're seeing United. That was up 3% here. I'm circling that. Southwest up almost 2%. Delta Airlines up 1.5%. So the airline's doing well today. Uber came roaring back. That's the biggest stock in the index. That was up 1.17%. And once again, I will leave off on our leaders here. And Bitcoin was a big winner overall. GBTC, that's my Bitcoin proxy, up 6.5% over the trading day. Chip stocks in the second place, and quantum, Korea, software, defense and aerospace, disruption, you name it, all those on the top row. And then IPOs, biotech, and China were the worst off today. And I'll send it back to you, Josh.
All right, thank you, Jared. Well, stocks closing today higher, renewing hopes for that so-called Santa Claus rally through year end, while our next guest expects stocks to rise into 2026. He recommends diversifying outside of the U.S. Joining me now, got Chris Maxey, WealthSpider Advisors Chief Market Strategist. Chris, good to see you. So maybe we'll start, Chris, kind of some big picture views here of the market. You do note here the recent market performance, you say, appears to be an unwind of concentrated positions rather than a broader risk-off trade. Walk me through that, Chris. What are you seeing in the market?
Yeah, that's a great question. So what we've been talking about with people is that as we look at the market over the last month, the market's relatively flat now. So yes, we had a moment where the S&P was trading down. You had unprofitable tech stocks that were beginning to get hit a little bit harder. And most of the narratives, most of the market conversation was around what's going on with those particular companies. And it was simply about too much leverage, concentrated positioning. We were coming off a very good run for the 6 months after Liberation Day and from April onward. So what we see right now is that people are just reassessing their positioning going into 2026. They're beginning to rethink that, okay, maybe the trades that I had earlier in the year are something that I want to be able to dial back. And what we saw in November was simply a rationalization of those positions, a stepping back from the market, starting to think about 2026, what's going on in the economy, and then it added a little bit of an extra element when the government shut down and we started to think about what the implications are when the Fed and other market participants are operating with less data at their fingertips.
You do note here, Chris, that several of the mega cap tech names, you point out, valuations, you say, now near 5-year lows. And that's despite, as you emphasize, accelerating earnings. So do you look at that, Chris, and say, hey, okay, that's an opportunity for investors.
Yeah, so what we've been talking about with a lot of folks is if you look at expectations for next year, they're growing. The anticipation is that the economy is going to grow, and that economic growth is going to translate to sales growth. It's going to translate to better profitability for a lot of the mega cap tech companies. But we see that now beginning to flow all the way down the market. So what we've talked about is this idea that even just the slightest pullback in those names is making them a little more attractive. And even as people have been asking us, okay, what about the parallels to, isn't that something? Really not seeing that at the moment. Valuations today are dramatically lower than they were at that point in time for similar companies. So yes, this has been a great opportunity. This is an opportunity to look at buying and participating in those names going into next calendar year.
You also do emphasize here, Chris, global diversification in the portfolio. Just big picture, how come, Chris? I mean, is that valuations? Is it FX? Is it policy divergence?
Yeah, so what we is that as you look at and what's happening there, it's been a good year overall. Part of what continues to be the case is that valuations are lower and the US dollar has moved down to the point that you were just making there. So we think a better valuation backdrop is one of those things that investors can lean on going forward. Yes, valuations are higher in the US, but that's going to be okay. I think we'll be able to navigate through that. When you look internationally, if you compare international stocks to mid cap, for instance, or small cap, the fundamental picture is stronger. So you now catch up with that fundamental picture.
And where specifically, Chris, as you're looking overseas, where are the compelling non-US opportunities? I mean, are there certain countries, regions, sectors?
Yeah, for us, we've been talking about developed stocks, but then also emerging markets. So on the developed front, you have lower valuations, but you have that better fundamental picture. With emerging markets, you get a little bit more participation in the growth opportunity. And, people are talking about AI and technology stocks in the US, but we're also beginning to see the rise of the AI trade in countries like China. If you had gone back 2 or 3 years ago, people didn't necessarily want to add more China into their portfolios because of a lot of the headwinds that were going on there. What we see at the moment, though, is people are now recognizing AI is beginning to build out, and that ecosystem, that community is growing in countries like China. So those are two areas that we're spending a little more time on more recently. But I think international as a whole is an interesting hedge for people that have a lot of tech exposure in the portfolios, because it does bring in value exposure, it brings in infrastructure, it brings in some energy stocks. It allows for a very different composition to what so many people here in the
Chris, you did mention the Fed and the risk here of these sort of data gaps because of that government shutdown. If that led to more, sort of choppier rate expectations, Chris, in the months and quarters ahead, how would you position for that as an investor? Does that mean, okay, I would need to get more defensive, I'm screening for quality? What's the move?
Yeah, where we're at right now, market is giving us a very strong indication that the Fed is going to cut in December. Forward, tells us that the Fed is going to continue easing. We should likely get more information on who the next Fed governor is going to be over the next coming weeks. It sounds as though that decision has already been made. But people also need to keep in mind that the Fed's quantitative tightening program is going to begin to slow down, if not stop altogether. And that's another one of those areas where it's going to be market supportive. So when we're thinking about policy and path forward for the Fed, strong indications that we're going to get a cut in December, but the path forward is going to continue to be one of easing. When we're thinking about the consummate reasons why, it's because labor markets, they're holding up okay, but they're not exactly thriving where we are at the moment. Yes, we're operating with we do see that markets are growing a little bit, but not necessarily as much as they need to. So with labor markets being where they're at, inflation coming down, decelerating a little bit, not quite yet enough, I think the Fed's going to lean on that labor mandate and wanting to support it and regrow the labor market.
Chris, great to have you on the show today. Thank you, sir.
Thank you.
Coming up, we hone in on CrowdStrike earnings. Don't go anywhere. Well, CrowdStrike is just out now with its third quarter results. Let's get you those numbers. Q3 EPS, 96 cents versus an estimate of 94 cents. Q3 revenue, 1.23 billion versus an estimate of 1.21 billion. So beats there on the bottom and the top. Let's get to the guidance. Q4 adjusted EPS calling for between 109 to 111. The estimate was 108. And Q4 revenue, they're calling for between 1.29 and 1.3 billion. The estimate was 1.29 billion. And for full year revenue outlook, they're now seeing, it looks like between 4.8 to 4.81 billion. They had seen between 4.75 and to 4.81 billion. Keep in mind, this stock had enjoyed a big run heading into this print. It was already up about 50% this year, and it looks like we're up about 0.6%, at least initially here in the after hours. But for a closer look at the results and the numbers, we've got RBC Capital Markets Managing Director and Head of Global TIMT Research. That would be Matt Hedberg. Matt, you've seen the results. What do you make of the report?
Yeah, I appreciate you having me on. As you noted, expectations were high coming into the print. The stock had a really strong move. Just looking at the numbers, it looks like a solid print. Net new ARR, which is the number we focused on, grew 23%. That accelerated versus 20% last quarter. ARR beat expectations, revenue beat expectations. And so, it was a really solid print across the board. And we look at Q4 guidance. It's effectively in line with consensus. So at first blush, it looks like a solid overall print.
I know you have a buy on the name, Matt. The stock, though, as we were talking about there, what a run year to date heading into this report, up around 50%. How would you think about and just kind of characterize valuation here, Matt?
Yeah, thanks, Josh. Yeah, we look at cybersecurity as a good place to be in the market right now, right? I mean, there's a lot of concern about, what AI's impact is on software overall. We see cybersecurity as more of a defensive space, and obviously with the potential threats increasing based on AI, we do see CrowdStrike as uniquely positioned there. And when we think about AI winners, these stocks often carry hefty traditional valuation metrics, but we've liked this name for the long term in terms of the growth and expansion opportunities. And so, we do think it's a uniquely placed asset.
Let me ask you about, just remind me, when we talk about that kind of broader cybersecurity market, who would you say are CrowdStrike's primary rivals, and what does CrowdStrike bring to the table that's different, Matt? What's the competitive advantage?
Yeah, I mean, when we think about traditional competitors, there's some legacy antivirus competitors that we don't see that much often. But in terms of broader, cyber consolidators, it's Palo Alto, it's Microsoft. And increasingly, those are two of their bigger rivals. But as the lines begin to blur between security and observability, we think the competitive landscape could increase in the future. And we think about what differentiates CrowdStrike. It really comes down to the architecture. We think it's a unique single code base that's cloud native, high retention, low churn. The ability to upsell modules is very high. And so we think in an area where cyber consolidation increases in the future, not decreases, we do think CrowdStrike is uniquely positioned to help customers consolidate spend.
How, Matt, is CrowdStrike leveraging AI? I ask as my buddy Dan Ives over at Wedbush. Here's how he put it, Matt. He says the street is underestimating the growth potential for CrowdStrike as a derivative beneficiary of the AI revolution. What do you think?
Yeah, listen, I tend to agree. I do think based on it all gets back to the architecture. And we think CrowdStrike is leveraging AI internally, because the challenge, as you're well aware, is that, adversaries are themselves using AI. And so to stop these zero-day threats, these unknown unknowns, as we sometimes call them, requires quite a bit of data, quite a bit of analytics. We think CrowdStrike is rather uniquely positioned to do that. And so, in the future, as AI threats increase, as CrowdStrike's able to increase their own AI efficacy, we do think they're in, again, a rather unique position to take mounds of data and ultimately help customers stay ahead of these adversaries.
Last one, Matt. I know you have a buy on this name. I'm just curious, though, when clients, Matt, those RBC clients, they ask you, okay, you're a believer, Matt, but what are the risks I got to think about? What do you tell them?
Yeah, I mean, all these stocks have risks. I mean, I think, competition is certainly, generally something that we talk about. There's an increased focus on consolidation, and some of the vendors that we noted before are competitors. I think, there's always the risk we saw with CrowdStrike with their outage a couple of years ago. These systems are important. They're interconnected. And so, there could be some unforeseen situation like that. But we generally think CrowdStrike has learned from a lot of what they've seen in the past. And we do think, as this platform continues to scale out, they're giving their customers a unique advantage here. So yeah, it certainly is not without risk, but we do think CrowdStrike is, again, rather uniquely positioned based on their platform and architecture.
Matt, always great to have you on the show. Thank you.
Thanks, Josh. Appreciate it.
Well, Marvell's third quarter results are hitting the wire, and we have Yahoo Finance's Dan Halley with the latest. Dan.
Yeah, Josh, they beat on the top and bottom line barely. They came in with EPS of 76 cents versus an estimate of 74 cents. They also saw revenue of 2.075 billion. That's 15 million ahead of the middle point of their guidance that they had provided. Expectations was for 2.06 billion. So a little bit of a beat there. And then for the coming quarter, Q4, they're expecting to see between 2.2 billion plus or minus 5%. That works out to about 2.09 to 2.31 billion. That's, again, about in line with expectations. But I think the big news here is that they announced that they're going to be acquiring Celestial AI. That's going to come in at a price tag of $3.25 billion. That's going to be broken down $1 billion in cash, as well as 27.2 million shares of Marvell common stock. That'll be valued at $2.25 billion. And as a result, we saw shares start to nosedive down more than 6% at one point before recovering slightly. And so obviously, the numbers met expectations after falling short of expectations as far as outlook goes in the prior quarter. That had sent shares down as much as 18% back in August, but now meeting expectations on outlook and the results themselves, but still shareholders not happy here.
Yeah, Dan, so we're down hard here in the after hours, and even heading into the print, Dan, I mean, not great. This stock was down about 16% year to date. I know most analysts on the street who cover the name, they are fans, but what do you think has been the concern or concerns about this name?
Well, back in August, it was about the irregularities with sales of its custom chips for cloud service providers. And, I think that that's going to be something continually in people's heads. I also think that, as we start to talk more and more about ASICs, that there's this conversation of, well, is it overwrought? This kind of, ASICs are going to eat the entire pie that NVIDIA has built up. And then the counter argument is absolutely not. The pie is just going to get bigger. I think that all kind of leads into these conversations that you see with companies like Marvell and Broadcom. And we're going to continue to see that moving forward. But I think at this point, really it has to do with its results from the prior quarter and then just meeting expectations now. And, expectations are already high for any company that's doing business when it comes to AI chips.
Final question, Dan. This company, as you mentioned there, I mean, they got big name rivals. You think about Hock Tan and the team over at Broadcom. I mean, what would you say, in that fight, Marvell's advantages are?
I think just its ability to be more nimble as a relatively smaller company. I mean, $2 billion in revenue, not too bad, but still, not absolutely massive. And so I think that's really where a company like Marvell can kind of shine when it comes to competing against a titan like Broadcom.
All right, Dan, thank you, sir. Well, that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. And I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.